The market has just done what markets often do at the most confusing point in a cycle. It has moved upward before the world has actually become safe. The S&P 500 and Nasdaq have both moved in a sharp V-shaped recovery over the last month. Bitcoin has moved strongly too, rising from the mid-60,000 range toward the 80,000 range at the time this analysis is being made. On the surface, that looks like relief. And in part, it is relief. Investors are reacting to the extension of the ceasefire between the United States and Iran. They are reacting to the idea that the conflict may not immediately become a broader global shock. They are reacting to earnings that have stayed stronger than many expected. They are reacting to the continuing momentum in artificial intelligence. But I want you to understand something very important. A rally is not the same thing as a resolution. The market can move before the facts are settled. It can discount hope before the risks are gone. It can behave as though the storm has passed while the structural conditions that created the storm are still sitting there, unresolved. That is what makes this moment dangerous and full of opportunity at the same time. Oil is still elevated because the supply risk around the Strait of Hormuz has not disappeared. The ceasefire is not permanent. The situation with Iran has not been fully resolved. There are still reports of new drone attacks and new pressure around us naval assets. The world is not back to normal just because asset prices have bounced. What we have right now is not a clean, all-clear signal. What we have is a short-term relief rally combined with strong earnings and continued AI enthusiasm. That is very different. When people confuse relief with resolution, they take too much risk at the wrong time. When they confuse fear with reality, they take too little risk at the wrong time. The job of a serious investor is not to react emotionally to either side. The job is to understand the machine, and the machine right now is telling us that markets are moving higher because investors believe the worst-case scenario has been pushed further away, not because the worst-case scenario has disappeared. That distinction matters. Markets are not rational in the way people want them to be rational. They are driven by liquidity, incentives, positioning, narratives, greed, fear, and the tendency of human beings to extrapolate the most recent price action into the future. When prices fall, people assume something is permanently broken. When prices recover quickly, people assume everything has been fixed. Both reactions are usually wrong. The market is a voting machine in the short term and a weighing machine over the long term. In the short term, it votes on emotion, positioning, and narrative. Over the long term, it weighs cash flows, productivity, earnings, money supply, debt cycles, and innovation. Right now, the short-term vote is saying relief. The long-term scale is still weighing inflation, oil war risk, Federal Reserve policy, earnings, and artificial intelligence. That is why I want you to think in probabilities rather than certainties. There is a case where this rally keeps going. There is also a case where the market takes another deep pullback. Neither case is absurd. Both are possible. The right approach is not to pretend you know exactly which one will happen. The right approach is to build a system that can survive both and benefit from either. One of the reasons markets have been able to move higher is that investors, including retail investors, still broadly believe the future will be higher than the present. A recent survey of a large global retail investor community suggested that a majority believe global stock markets will be higher in 12 months. A large share of those investors plan to put meaningful money to work over the next year. Many also believe Bitcoin will be higher in 12 months. At the same time, many are increasing cash reserves and thinking about full portfolio changes. That tells you something important. People are not fully euphoric. They are not fully afraid either. They are trying to prepare for both directions. They want upside, but they also want optionality. That is why the most sensible move for most people is not to sit entirely in cash waiting for the perfect crash. And it is not to go all in because the market bounced. The move is to systematically accumulate the best asymmetric assets over time while keeping enough liquidity to buy more aggressively if the market gives you another large discount. This is not complicated. It is hard only because human psychology makes it hard. If you had been steadily buying through the uncertainty earlier this year, you would already be meaningfully up in many parts of the market. If you waited for perfect clarity, you missed the first part of the recovery. And if you are now tempted to chase everything because prices went up, you are at risk of doing the opposite mistake. The principle is simple. When you do not know the exact timing, you control the process. You dollar cost average into assets you believe have strong long-term odds, and you keep extra cash available for volatility. You do not let the absence of certainty become an excuse for doing nothing. Historically, markets spend more time in bull conditions than in bear conditions. The S&P 500 has finished positive in most years. That does not mean markets cannot fall. They can fall very hard. It means that staying permanently sidelined while waiting for the perfect entry point is usually a bad game for people who are still in the wealth accumulation phase. And this is especially true when the world is entering one of the greatest technological transitions of our lifetime. Artificial intelligence, robotics, automation, and digital infrastructure are not small cyclical themes. They are the kinds of forces that change labor, productivity, capital allocation, and the bargaining power of different groups in society. When people like Elon Musk speak publicly about universal high income or government checks as a response to AI unemployment, You should not treat that as a strange comment floating in the air when Sam Altman talks about universal basic wealth. You should not dismiss it as a fantasy. When governments begin openly discussing universal basic income for workers displaced by AI, you should understand what is really being said. The people closest to the technology are telling you that the labor market may change structurally. They are telling you that many people may become consumers in an economy increasingly owned by the people who own the machines, the models, the data centers, the chips, and the platforms. That creates two different paths. On one path, you do nothing. You remain only a worker and a consumer. You rely on wages that may be pressured by automation. You rent from asset owners. You consume products made by systems you do not own. You wait for governments to decide how much support you receive. On the other path, you prepare. You invest in productive assets. You diversify across systems. You own pieces of the companies and networks that benefit from this transition. You hold assets that cannot be printed away easily. You study the flow of liquidity, attention, and innovation. You build enough financial independence that you are not simply carried by the system. That is the difference between being on the wrong side of a technological revolution and being on the right side of it. Money does not solve every problem. It does not create meaning by itself. It does not replace character, relationships, health, or purpose. But money changes your options. It changes your ability to choose where your children go to school. It changes whether a problem becomes a crisis. It changes the neighborhood you live in, the risks you can take, the opportunities you can pursue, and the amount of time you have before you are forced to accept someone else's terms. That is why the people who treat investing as entertainment usually lose. The people who treat investing as a system have a chance. We are already seeing the great wealth transfer begin. AI companies are being valued at extraordinary levels. Large technology companies are committing enormous sums to infrastructure. Google, Microsoft, Meta, and others are pushing hundreds of billions of dollars into AI capacity. The people who own the platforms, the data, the infrastructure, and the distribution are building the rails of the next economy. Many people are still responding the way people responded in the early stages of previous shocks. They say it will not affect them. They say it is a bubble. They say the technology is not good enough. They say their job is safe, or they believe the change is coming and still do nothing. That last group is the saddest to me. Knowing something may happen and failing to prepare is one of the most expensive mistakes a person can make. During the early stages of the pandemic, many people also assumed it would remain far away. Then suddenly the world changed. Markets crashed, governments printed, supply chains broke, and those who had prepared had choices while others had only reactions. AI is not the same as the pandemic, but the pattern of disbelief is familiar. People often ignore a changing reality until it appears on their doorstep. By then, the best prices are usually gone. So let me bring this down from the big picture to the actual framework. The problem most investors face today is not a lack of information. It is too much information. In the past, retail investors did not have access to the tools and research that large institutions had. Today, information is everywhere. Social media floods people with opinions. AI tools can explain companies, markets, and themes in seconds. Anyone with enough money can buy professional data tools. The advantage is no longer just access to information. The advantage is filtering. The person who wins is not the person who sees every headline. The person who wins is the person who knows which few variables actually move the system. Right now, there are 5 major variables I would focus on. The first is the war risk around Iran. Markets are reacting to headlines, but the deeper question is whether the conflict changes the real flow of oil, the cost of energy, the risk premium in markets, and the willingness of investors to hold risk assets. The United States wants to prevent Iran from maintaining highly enriched uranium and expanding that program. It wants to reduce Iran's missile capabilities. It wants to keep the Strait of Hormuz open for oil tankers without Iranian control or tolls. Iran wants the war pressure to end. It wants sanctions lifted. It wants compensation. It wants authority over the Strait of Hormuz. It wants to continue its nuclear program. It wants US forces reduced or withdrawn from the region. Those objectives do not line up cleanly. That means the most likely path may not be total war or total peace. It may be a messy middle path where blockades, negotiations, flare-ups, isolated incidents, and temporary relief periods keep repeating. Markets can rally inside that messy middle, but the risk does not disappear. The second variable is oil. Oil is the fastest way a geopolitical shock enters the everyday economy. It moves through gasoline, diesel, shipping, fertilizer, plastics, food, airline costs, industrial margins, and consumer behavior. If oil stays high, inflation stays sticky, corporate margins get pressured, consumers have less money left after necessities, risk assets become more vulnerable. If oil cools down, the market gets breathing room. That is why oil is not just an energy price. It is a liquidity transmission mechanism. The third variable is inflation and interest rate policy. Markets want lower rates because lower rates increase liquidity, support borrowing, lift housing demand, and make future earnings more valuable. But the Federal Reserve cannot simply cut rates if oil-driven inflation is moving in the wrong direction with Jerome Powell leaving and Kevin Warsh expected to take over. Many investors are watching for a more favorable rate environment, but even if leadership changes, the constraints do not disappear. If inflation rises again because of oil, energy, and supply costs, the Fed has less room to ease. Markets usually price these changes before they happen. The probability of a cut can move prices even before the cut occurs. That is why you have to watch expectations, not just decisions. The fourth variable is corporate earnings. Earnings have been one of the major reasons the market has stayed more resilient than many expected. If earnings keep growing, the market can absorb a great deal of bad news. If earnings begin to weaken while inflation remains high, the setup becomes much more dangerous. At the end of the day, stock prices follow liquidity in the short term, but over time they must be justified by earnings and margins. If those continue to improve, the rally has more support. If they deteriorate, the rally becomes more fragile. The fifth variable is AI optimism. The market is trading heavily on whether investors believe the AI story is still intact. A single headline around cheaper AI models, such as the deep AI sell-off earlier in the cycle, can trigger massive moves in companies like Nvidia. When investors believe AI leadership is threatened or that spending may slow, the market reacts violently. When AI progress appears strong, capital flows back into the largest technology companies and the infrastructure around them. That is why you cannot treat AI as just another sector. It is now tied to market psychology, capital expenditure, data center demand, semiconductor demand, energy demand, and future labor expectations. When you focus on those five variables, the noise becomes easier to filter. Ask yourself whether a headline changes the warpath, oil prices, inflation and rates, corporate earnings, or AI optimism. If it does not change one of those, it may not matter much. If it does change one of those, it matters a lot. That is how you avoid drowning in information. So what happens next? If oil cools, inflation stays contained, earnings remain strong, and AI optimism continues, the market can grind higher from here. That is a reasonable scenario. If oil remains elevated, inflation reaccelerates, the Fed cannot ease, and earnings begin to disappoint. Another correction becomes likely. That is also a reasonable scenario. The mistake is not having a view. The mistake is having only one plan. I do not care very much whether I am perfectly right in the short term. I care whether my strategy works over a range of outcomes, over a 2-year, 5-year, and 10-year period. I believe productive assets tied to major technological change are likely to be much higher than they are today. If you agree with that higher time frame view, then you need exposure now. You can still keep cash, you can still buy more on dips, but being completely out of the market because you want perfect certainty is usually the wrong game. That brings us to asymmetric opportunities. An asymmetric opportunity is not simply something that can go up. Almost everything can go up. It is a situation where the upside is much larger than the downside, where the narrative is not fully priced, where liquidity is likely to return, where attention can shift quickly, and where you have a reason to believe the market has not yet understood the full implication. The strongest opportunities usually happen when several forces align. There is a strong narrative before the crowd fully understands it. There is a path for attention and liquidity to move into it. There is a chart or price structure that has not yet fully priced the opportunity. There is evidence of relative strength during fear. And there is a catalyst that could make the broader market suddenly care. That is what happened with earlier crypto opportunities that turned small positions into very large outcomes. The pattern was not magic. It was narrative, liquidity, attention, timing, conviction, and risk. When Coinbase was building Base and the ecosystem around it was still not obvious to most people. There were assets that gave exposure to that growth before the crowd arrived. Aerodrome became one of those examples. The thesis was simple. If Base becomes important, the decentralized exchange sitting at the center of that ecosystem may capture liquidity. When the thesis was early, the price still reflected disbelief. When the thesis became obvious, the price no longer offered the same asymmetry. That is the kind of setup serious investors look for. But this is also where people get hurt. They hear a story after it already worked. They chase the chart. They buy because they feel regret. They do not define the invalidation point. They do not understand the liquidity. They do not know when to sell. Then they call it investing when what they really did was emotional gambling. The right question is not whether something is exciting. The right question is whether the decision is calibrated. When I look for these opportunities, I want to know what held up during uncertainty. When an asset refuses to die during fear, I pay attention. That relative strength can tell you where demand is hiding. It does not guarantee anything, but it gives you a signal. I also want to understand where attention will return fastest when conditions improve. Markets do not recover evenly. Money rotates. One theme explodes, then another, then another. In crypto especially, liquidity is thinner than it was in the wild 2021 cycle. Retail investors are more aware. The easy money may not return in the same way. That means selectivity matters more. You cannot just buy everything green. You build a watch list. You study the narratives. You track momentum. You watch liquidity. You understand which assets have real catalysts and which are only temporarily popular. And then when the conditions align, you act decisively. Most of the year is not the time to be aggressive. Most of the year is chop. Most of the year is noise. The great gains often come from a small number of periods when trend, liquidity, sentiment, and catalysts all line up. That is true in markets, and it is true in many other systems. A fisherman knows that there are times when nearly anything works because the conditions are right, and there are times when you can do everything perfectly and still catch nothing. Markets are similar. When conditions are poor, overtrading destroys capital. When conditions are right, hesitating destroys opportunity. The skill is knowing the difference. One strange but useful signal is retail attention itself. When people stop watching, stop caring, and stop asking about the market, that can be a sign that the crowd is asleep. Retail often arrives late and leaves early when the market is boring or painful. The serious investor does the work when the market becomes exciting and everyone returns. The serious investor already has positions and is thinking about risk management. Do not rely on that signal alone. It is only one factor. But when you combine low attention with strong narratives, improving liquidity, relative strength, and major catalysts, you begin to see a clearer picture that brings me to the assets I would be watching in this environment. Bitcoin remains the core digital asset exposure. The thesis does not need to be complicated. If Bitcoin holds above the levels where the long-term thesis remains intact, systematic accumulation makes sense for those who understand the volatility and accept the risk. If Bitcoin revisits lower buying zones, that can become a more aggressive deployment opportunity if it breaks higher. Through confirmation levels, that can also signal renewed risk appetite. But Bitcoin should still be sized properly. It is volatile. It should not be confused with a guaranteed outcome. For investors who already made meaningful wealth, the purpose of Bitcoin may shift from full wealth creation to a combination of preservation, upside, and diversification. The next area is hyperliquid and the hype ecosystem. What makes hyperliquid interesting is not simply that it is another token. It is that it appears to be building one of the deepest liquidity venues in crypto, with significant fees, meaningful TVL, large perpetual volume, and a very aggressive value accrual mechanism where much of the revenue is routed back into buybacks. That is structurally different from many projects that depend only on narrative. The HIP-3 upgrade matters because it allows permissionless deployment of new perpetual markets. That expands the system beyond ordinary crypto trading. If users can trade oil, gold, silver index exposure, large equities, and crypto through the same venue, then the addressable market becomes much larger. It begins to look less like a niche crypto exchange and more like an on-chain financial infrastructure layer. The next catalyst is HIP-4, which introduces native prediction markets. Prediction markets have already shown meaningful volume and user demand elsewhere. If Hyperliquid captures even a meaningful slice of that flow and routes more fees back into token demand, the flywheel can become powerful, but there is risk. The main structural criticism is decentralization. If the validator set is limited, then the system has a centralization concern. That may not matter much in a speculative cycle, but it matters over the long term if the goal is credible neutrality. A serious investor must weigh both the upside and the weakness. There is also a more leveraged way to watch the same theme through PER, the treasury company linked to hype exposure. It is not a crypto token. It is a listed equity structure with hype tokens in treasury, remaining deployable capital, an equity line, and a share repurchase program because it connects traditional equity markets to crypto exposure. It can become interesting when risk appetite returns and traditional investors want a familiar wrapper. But again, structure matters. If it is trading near net asset value, there may not be a deep discount. The opportunity is not risk-free. It is a power play that depends on market conditions, investor attention, and the continuing strength of the underlying ecosystem. Then there is MicroStrategy. The thesis is simple. It is a regulated equity wrapper for leveraged Bitcoin exposure. If Bitcoin moves materially higher, MicroStrategy has historically amplified that move. If Bitcoin falls sharply, the same amplification works against you. That is why it must be treated as a leveraged risk asset, not as a conservative holding. Still, if large institutions continue to move toward higher Bitcoin price targets, and if MicroStrategy keeps accumulating Bitcoin, the trade can continue to matter in the next risk. On phase, it may not offer the same kind of extreme asymmetry as early-stage assets, but it can offer strong exposure to the Bitcoin cycle. The next area is the high-cap meme coin allocation, represented here by Pengu. Every crypto cycle tends to produce one or more consumer-facing meme assets that capture enormous attention. Dogecoin did it, Shiba Inu did it, other cycle-specific tokens did it. The thesis around Pengu is that it sits at the intersection of brand liquidity, product market fit, consumer attention, and crypto native culture, but the risk is obvious. Meme coins are highly volatile. They can dilute attention quickly. They can collapse without warning. They are not cash-flowing businesses. They are vehicles of narrative, liquidity, and community. That means position sizing and exit discipline matter even more than entry. The next asset to watch is BMNR, connected to the Ethereum narrative through a public market structure and a strong promotional face in Tom Lee. Ethereum may not feel as new or explosive as some newer tokens, but it remains one of the core crypto networks. When broader liquidity returns, Ethereum-related vehicles can regain attention quickly. The reason BMNR is worth watching is not only the Ethereum exposure, it is the ability of a public market structure with a recognizable spokesperson and significant funding to attract traditional investor attention in a crypto bull phase. But once again, watching is not the same as blindly buying. You put it on the list, you study the holdings, the net asset value, the premium or discount, the catalysts, and the conditions under which the trade becomes attractive. Putting all of this together, the structure is clear. Have some core Bitcoin exposure if you believe in the long-term thesis. Use higher beta equity wrappers like MicroStrategy only if you understand the leverage and volatility. Continue to watch Ethereum and Solana ecosystem exposure. Treat hype as one of the stronger high-conviction altcoin themes if the data continues to support it. Watch Pengu as a consumer meme allocation rather than a core investment. Watch PER and BMNR as traditional market wrappers that may attract capital when liquidity returns. But do not forget the most important part. The best asset in the world can still be a bad investment if bought emotionally, sized incorrectly, or held without an exit plan. Conviction is not stubbornness. Conviction is what remains after research, probability, risk management, and humility are all included. If you do not do the research, you will not have conviction. If you do not have conviction, volatility will shake you out. If you have conviction without risk management, ego will destroy you. You need all three: research, conviction, and controls. That is the principle. Markets are entering one of the most important periods of our generation. AI may change labor, crypto may continue to mature into a parallel financial system. Governments may respond to debt and unemployment with more money creation. Energy and inflation may remain volatile because geopolitics are unstable. The market may rally, correct, and rally again. None of this should surprise you. The goal is not to predict every move. The goal is to build a system that keeps you in the game, gives you exposure to the upside, protects you from being forced out during the downside, and allows you to act when the odds become unusually favorable. Most people will not do that. They will wait until it feels safe, which usually means the easy money has already been made, or they will panic when it feels unsafe, which usually means the better prices are appearing. They will consume the story after the opportunity has already been priced. You do not have to be one of those people. Pay attention, filter the noise, study the few things that actually move markets, accumulate systematically. Keep liquidity, build a watch list, act only when the setup is clear. Take profits when the crowd becomes irrational. And above all, stay grounded, because the market will test you. It will test you with fear. It will test you with greed. It will test you with regret. It will test you with the feeling that everyone else is getting rich faster than you are. It will test you with crashes that make your thesis feel foolish and rallies that make discipline feel unnecessary. That is why you need principles. Whether a person is grounded by faith, family purpose, or a set of hard-earned rules, they need something stronger than the latest candle on a chart. When you are rooted, you do not react to every wave. You can think clearly, you can make better decisions, you can avoid becoming a victim of your own emotions. The next wealth opportunity will not be captured by the people who merely watch headlines. It will be captured by the people who understand the system, stay prepared before the crowd returns, and have the courage to act when the data, the narrative, the liquidity, and the risk reward all line up. That is how you position for generational wealth. Not by guessing, not by chasing, by preparing before everyone else realizes what is happening.